Now, joining me now, Emily Rowland, co-chief investment strategist, John Hancock. Welcome. It's good to see you here on this Friday in overtime. So we thought today was going to be pretty good. Then we had a rollover midday on those headlines out of Europe. How does it make things set up now for next week, do you think?
Yeah, big reversal today. I think this morning there was a lot of optimism that the jobs report really checked all the boxes for the Fed. Job growth remaining robust, but wage growth coming off the boil, the participation rate ticking higher. Goldilocks was the word of the day this morning. And then, of course, we get these concerns around European energy with the delay of the major pipeline over there, causing global growth concerns. And then we saw, this big backup in the 10-year Treasury yield that we've been seeing really over the past month reverse course. And we think that that's about right. When you see inflationary pressures starting to recede, and we've seen a lot of evidence of that over the course of the week, that should bring bond yields lower. And ultimately, those inflation fears, Scott, will turn into growth fears as global growth clearly is decelerating, likely heading into a recession at the end of this year and into next year. So we think embracing bonds right now actually does make a lot of sense.
That said, you do have some stock picks, and one of them, at least one of them is a little curious to me, in the environment in which you just paint, and that's Google. If you think we're going to go into recession and a broad economic slowdown, wouldn't this suffer?
Yeah, in a recessionary environment, you really want to notch up on quality. So we're talking about companies with great balance sheets, ability to maintain their margins, grow organically, lots of cash on their balance sheets, and we want to own them at a reasonable price. We don't want to own unprofitable tech companies, growth at any price type companies that need to tap the capital markets in order to grow. So right now, Google has all those things. We have great balance sheets, good free cash flow, trading at about 19 times forward earnings versus a 5-year average of around 25 times forward earnings. So really sort of checking all the boxes for us on the quality front.
Yeah, healthcare is very popular right now. You like JNJ off that list.
Yeah, when we think about this late cycle environment where economic growth is cooling, the Fed's raising rates, and earnings growth is starting to, see downward revisions here, we really want to own companies that have not only that quality element, which J&J has, but also some defensiveness to it. So we're seeing a big change in consumer behavior just starting to play out here as consumers are transitioning away from the things that they want, those discretionary items, and the things that they need, given that the marginal dollar is now going towards higher commodity and food prices and gas prices. So we think more defensive companies like J&J will benefit from that change in consumer behavior. People are still going to need to buy those Band-Aids, as you mentioned in the previous segment, as well as, engaging in the pharma part of the company as well.
Yeah, getting nicked up by this market. Going to need many Band-Aids. Emily, thanks. We'll see you soon. Enjoy the weekend.